This isn't a crash everywhere, but some markets are cracking. And here's what most people miss. The biggest housing shifts don't announce themselves with headlines. They show up quietly in the data, weeks or even months before anyone's talking about it. So today, I'm breaking down 7 signals that can predict when a U.S. housing market is turning, before the news catches on, before your neighbors notice, and definitely before prices reflect it. These aren't theories. These are data points you can track yourself right now in your own city. Let's get into it.
Hey, welcome to the channel. If you're new here, this is where we break down U.S. housing market trends. No hype, no fear, just data and clarity. Now, before we start, quick disclaimer, this is not financial advice. I'm not telling you to buy, sell, or hold. What I am doing is walking you through the framework I use to read housing markets so you can make smarter decisions for yourself. And one more thing to clarify. When I say turning, I don't always mean crashing. Some markets turn from red hot to normal. Some turn from normal to weak. And yes, a few turn from weak into something much worse. The goal here isn't to panic. The goal is to recognize the shift early so you don't buy at the absolute worst time or sell too late and leave money on the table. Because here's the truth. Most people wait for confirmation. They wait until everyone agrees the market changed. But by then, the opportunity to act strategically is already gone. So let's make sure that doesn't happen to you. Signal number 1 is inventory. Inventory is the simplest concept in real estate, but it's also one of the most powerful leading indicators. It's just this: how many homes are for sale right now compared to the recent past? When inventory is low, buyers compete. Sellers have the power. Bidding wars happen. Prices climb. But when inventory starts rising, the dynamic flips. Buyers get options. Sellers lose leverage. And that shift happens fast. In a strong seller's market, homes are scarce. Maybe there's only 1 or 2 weeks' worth of supply. Buyers feel the pressure to move quickly or lose out. But in a turning market, listings begin to stack up. At first, it's quiet. Maybe inventory goes from 2 weeks to 4 weeks, then 6, then 8. And that's when sellers start to feel it. Here's a simple real-world test you can do today. Drive through your neighborhood or browse Zillow in your area. Are you seeing more for sale signs than you did 6 months ago? If the answer is yes, inventory is already telling a story. Now, if you want to back that up with actual data, one of the easiest places to check is the Redfin Data Center. They track inventory, new listings, median prices, and more. And it's updated regularly for most major metros. But here's the key. Don't just look at inventory levels, look at the direction and the speed. A slow, steady rise in inventory usually means the market is normalizing. That's healthy. That's not a crash, it's balance returning. But a sharp, sudden spike in inventory, that can mean demand is breaking. That can mean buyers are pulling back fast and sellers are flooding the market trying to get out before things get worse. And when that happens, prices don't stay flat for long. So ask yourself, in your city, is inventory rising slowly or spiking? Because that difference matters more than the number itself.
Signal number 2 is days on market. This is one of my favorite signals because it's so direct. It cuts through all the noise and tells you exactly what's happening with buyer demand. When demand is strong, homes sell fast. We're talking offers in the first week, sometimes the first weekend, multiple bids, done deal. But when demand starts to weaken, homes sit. And when homes sit, sellers start to sweat. Even if the median price in your city is still high, even if headlines are still saying strong market, if days on market is climbing, that's a warning sign that leverage is shifting. Because here's what happens in the real world. A seller lists their home. Week 1, a few showings, but no offers. Week 2, fewer showings. Week 3, silence. By day 30, they're wondering if they priced it wrong. By day 45, they're getting nervous. By day 60, they're willing to accept offers they would have rejected a month ago. This is how the market turns without looking like a turn in the headlines. Prices might still be reported as stable because the homes that did sell, the ones priced right, sold at decent numbers. But the homes that are sitting, those are the canaries in the coal mine. So here's what you do. Track the average days on market in your metro. Compare this month to 3 months ago. Compare this quarter to last quarter. If days on market is rising, especially if it's rising fast, that tells you buyer urgency is fading. And when urgency fades, negotiating power shifts to the buyer. Zillow, Redfin, Realtor.com, they all publish days on market data. It's public, it's free, and it's one of the clearest signals you'll find. Signal number 3 is price cuts, and this one is huge. Price cuts are the market's way of saying that price is not real anymore. Here's how it plays out in the early stage of a market shift. Sellers don't want to admit the market changed, so they list at the price their neighbor got 6 months ago, or the price Zillow's estimate says, or the price their agent threw out to win the listing. Then the market ignores them. Showings are light, offers don't come, and after a few weeks, reality sets in, so they cut the price. 5%, then another 3%, then another 2%. And when you start seeing price cuts spread across a neighborhood, not just 1 or 2 oddball listings, but a pattern, that's a signal that the old pricing era is ending. Now, Zillow tracks price cuts as part of its research tools, and it's a fantastic resource if you want to see how many listings in your area have reduced their price. But here's what I want you to understand. Price cuts are lagging confirmation of something that already happened. The demand already weakened, the buyers already pulled back, the inventory already rose. Price cuts are just sellers catching up to the new reality. But here's the thing. Most buyers and most investors wait until they see widespread price cuts before they adjust their strategy, and by then, the easy wins are gone. If you're a buyer and you're seeing 10, 15, 20% of listings in your target area showing price reductions, you're not early anymore, you're on time, maybe even a little late. But if you're seeing just 3 to 5% of listings with cuts and inventory is rising and days on market is creeping up, that's your early signal. That's when you start being more cautious, more patient, and more aggressive in your negotiations. And if you're a seller in that environment, here's the hard truth. Your biggest mistake is thinking your home is different. It's not. If the market is shifting, your home is part of that market. And the longer you wait to price correctly, the more you'll have to cut later. I've seen this play out in cycle after cycle. The sellers who win are the ones who price right early. The ones who lose are the ones who chase the market down with cut after cut after cut. So pay attention to price cuts, not just the number, but the trend.
Signal number 4 is mortgage rates. And I'm not just talking about the rate itself, but the direction and the stability. Here's why this matters. When rates spike, or when they swing wildly from week to week, buyers freeze. Not because they don't want a home, but because they can't predict the payment. Think about it. A buyer gets pre-approved at 6.5%. They start looking at homes in a certain price range. 2 weeks later, rates jump to 7.2%. Suddenly, the same home costs them $200, $300, even $400 more per month. That's enough to push some buyers out of qualification entirely. And even for buyers who still qualify, it's enough to make them pause and rethink. And when buyers pause, demand drops. And when demand drops, inventory rises. And when inventory rises, sellers start cutting. So mortgage rates don't cause everything, but they absolutely interact with everything else. Now, if you want a reliable benchmark to track, Freddie Mac publishes the Primary Mortgage Market Survey every week. It's the standard reference most analysts and lenders use, and it's free to access. But here's what I want you to focus on. It's not just about whether rates are high or low, it's about the combination. If rates are high and stable, buyers can adjust. They'll reset their expectations, look at smaller homes, or wait for their income to catch up. But if rates are high and rising, and inventory is also rising at the same time, that's a dangerous combination for sellers. Because now you've got buyers who are priced out or waiting on the sidelines, and you've got more homes competing for fewer buyers. That's the setup for price pressure. And here's the part that surprises people. Even when rates eventually drop, it doesn't always bring buyers flooding back immediately. Why? Because if prices fell while rates were high, buyers are now wondering if prices will fall more, so they wait, and that waiting creates its own momentum. This is why I always say, watch the interaction, not just the number. Rates plus inventory plus days on market. That's your real signal. Signal number 5 is mortgage applications, specifically purchase applications. This is one of the closest things we have to a real-time demand signal. If fewer people are applying for mortgages to buy homes, that means fewer people are actively in the market. It's that simple. The Mortgage Bankers Association publishes the weekly application survey, and it breaks down purchase applications separately from refinance applications. And here's why this is so valuable. Mortgage applications lead closings by 30 to 60 days. So if applications are falling today, that means closed sales will be lower next month. And if closed sales are lower, that means demand is softening before it even shows up in the price data. This is an early warning system. Now, let me show you the pattern I see over and over in turning markets. First, mortgage applications soften. Buyers pull back, maybe because of rates, maybe because of prices, maybe because of job uncertainty. Then, days on market starts to rise. Homes sit longer because there are fewer buyers competing. Then, price cuts spread. Sellers realize they're not getting the activity they expected. And finally, median prices start to flatten or fall. But by then, everyone knows the turn already happened. So if you're tracking mortgage applications and you see a consistent downtrend over several weeks, that's your heads up. It doesn't mean the market is crashing tomorrow, but it does mean demand is cooling, and you should adjust your expectations accordingly. For buyers, this is good news. It means you have more time, more options, and more negotiating room. For sellers, it's a signal to be realistic and move quickly if you need to sell.
Signal number 6 is building permits and new construction pressure. This one is especially important in fast-growing metros, places like Austin, Phoenix, Boise, Nashville, Charlotte, and parts of Florida and Texas. Here's the idea. When builders are active and new supply is coming online, that pushes the market toward balance, and in some cases, toward oversupply. Now, why does this matter? Because builders are often the first to discount, but they don't always do it in the obvious way. You won't always see builders slashing prices by 10% or 20%. Instead, they offer incentives, rate buydowns, free upgrades, closing cost credits, HOA credits, appliances, whatever it takes to move inventory. And once builders start competing harder, resale sellers suddenly have to compete too. If a buyer can get a brand new home with a 4.99% rate buydown, why would they buy a 15-year-old resale home at 7%? They won't. So resale sellers either drop their price or sit on the market. The U.S. Census Bureau publishes the Building Permit Survey, which tracks new permits issued across the country. It's a solid official source, and it's updated monthly. Now here's what to watch for. If permits are rising and inventory is rising, that's a signal that supply is building faster than demand. And if that's happening in your city, it doesn't mean prices will crash overnight, but it does mean pricing power is shifting. Builders control new supply, and when they need to move homes, maybe because they have debt to service or investor timelines to meet, they'll do what it takes, and that puts pressure on everyone else in the market. So if you live in a city with heavy construction activity, check the permits data. Compare this year to last year. Look at how many units are in the pipeline. Because when supply grows faster than demand, prices don't need a crash headline to start falling. They fall because buyers have options. Signal number 7 is the job market, especially unemployment direction. Housing is emotional, but it's also math, and the job market is the foundation of that math. When people have stable jobs and rising incomes, they buy homes. When layoffs rise and job security weakens, buyers pause. And when buyers pause, sellers chase. Even if your city has beautiful homes, great schools, and strong neighborhoods, if the local job market is softening, housing demand will soften too. So here's what you track: the unemployment rate in your metro area and the direction it's moving. The Bureau of Labor Statistics publishes unemployment data by metro, and it's updated monthly. You can pull up a chart in under a minute. Now, I'm not saying you need to wait for unemployment to spike before you pay attention. In fact, by the time unemployment is spiking, the housing market is usually already turning or turned. What you're looking for is the early trend. Is unemployment ticking up from 3.2% to 3.6%? That's a small move, but it's a direction. Are local companies announcing layoffs? Are job postings slowing down? Are people in your network talking about hiring freezes? Those are real-world signals that show up before the official data catches up. And here's the connection to housing. When someone loses their job, or even fears they might, buying a home moves way down the priority list. They're not touring open houses, they're updating their resume. And if enough people in a city are in that position, demand drops fast. This is why I always say, housing markets don't crash in a vacuum. They crack when the fundamentals underneath them, jobs, income, and affordability, start to shift. So pay attention to your local economy, not just housing, because housing follows employment, not the other way around. All right, let's put all 7 signals together into a simple framework you can use to evaluate any U.S. city. If inventory is rising and days on market is rising, the market is cooling. That's your foundation. If price cuts are spreading and mortgage applications are weakening, the market is likely turning. That's your confirmation. If new construction is heavy and the job market is getting shaky, risk is increasing fast. That's your warning. Now here's the biggest mistake people make. They wait for all 7 signals to flash red at the same time before they act. But markets don't work that way. By the time every signal is screaming red, the best opportunities are gone. If you're a buyer, your advantage isn't timing the exact bottom. Your advantage is avoiding the worst deal. So track these 7 signals in your metro. Compare the last 3 months to the prior 3 months. Look for direction, not perfection. If you're a seller, the message is simple. The market doesn't care what your neighbor sold for in 2022. If the signals are turning, price correctly early. It beats chasing the market down later every single time. And if you're an investor, remember this. Turning markets create 2 kinds of people, those who panic and those who plan. Your job is not to be emotional. Your job is to be early, careful, and data-driven. Now, I want to make this practical for you. This week, look for these real-world signs in your city. Are there more listings than 3 months ago? Are homes sitting longer? Are you seeing price reduced more often on Zillow or Redfin? Are builders offering big incentives? Are people in your area talking about job cuts or hiring freezes? Because these are the early warning signs you'll feel in real life before the national headlines change. And if you want, drop a comment with your state and city, and I'll run this 7-signal checklist on your area in a future video. If you found this helpful, subscribe, because this channel breaks down U.S. housing market shifts, and we're just getting started. Thanks for watching. I'll see you in the next one.